Welcome to Deal Talk. I'm Jeffrey Veit. Let's talk about avoiding dealer tricks, buying smart, and current events in the auto industry, just like we do every single week almost. That way you're going to save some money, maybe big money, on your next lease or purchase of a car, truck, motorcycle, boat, motorhome, whatever. Here's a good question. Should you consider buying a dealership loaner vehicle? That question came up in the last week or so. You might think it's owned by the dealer. It would be, decent because it had been cared for and or had reliable upkeep. The price might be below average because the dealer will want to dump it. I checked around a bit on the net to see what, the answers to this question were on the net. And even Consumer Report said yes, if you look it over good, it might be a possibility. Have you ever had a shopping cart at a store that looked great, but the wheels wobbled and the handle was broken? It seemed to dog track, that angle differently than the point of something that dogs do when they walk. They kind of have their back legs over to the right or to the left of their front legs. You ever have a car that you did that way, you pushed her, maybe the wheel was stuck or whatever? My advice is to avoid a loaner vehicle like the plague. Too many other vehicles for sale to take that chance. Why? They're usually only serviced when they break down. The dealer doesn't pay any attention to that vehicle. They got too much, going on. They don't pay any attention. And if it breaks down, then they service it. They have more drivers than a rental vehicle. I mean, let's face it, there's probably a different driver almost every day. They've usually had a lot of cosmetic damage, although fixed, it's still there. It still means it's got Bondo or dents fixed and all that kind of stuff. They have no real care. They just are. Different drivers and a lack of any maintenance take a toll that may not be completely visible, but it's almost always there. I don't know. I'm not saying there isn't some loaner car out there that's a good buy, but 99 out of 100 are not. If the dealer's dumping a loaner vehicle, there's usually a reason, right? It may seem fine at the moment, but what is the unseen history? What don't you see that's happening inside there? How much has the suspension been banged in the curbs, and how long have smaller problems been ignored? You know what I mean? And how much have they tinkered with? And maybe the dealer's thinking, well, it's getting a lot of miles on it. Let's get rid of that, right? Will the inside smells of a loaner vehicle service, will it come back to where it smells normal again? I mean, I don't know if you've ever sat in a loaner vehicle, but boy, they can be hideous, I'll tell you. Unless you're buying it for 30 or 40% of the book value, maybe even 50%, why would you take the chance? You might get a warranty, but how does the pay for the inconvenience or the lack of confidence on a trip or the future in general get handled, right? You don't get paid for that. No, the fact that you can't trust, the fact that you're worried about it all the time you're driving it. There's no saving grace to them. There's no reason to say, wow, there's a vehicle that's cared for. Let's get that one. If you must buy in that market area, if you need to get into that market, that big savings market, you're better off with a rental than you are with a loaner vehicle, for sure. Loaner vehicles are they're like stepchildren. They just get ignored, or can get ignored, I should say. But I thought that question was a good one, and it's worth talking about because dealers have loaner vehicles and they sell them. Well, I want to tell my listeners, don't buy them. Just don't. If you like the show, please take a couple of minutes and do a review on whatever podcast source you use, if you could. I'd appreciate it. If you've already done a review, thank you so much. There's a bunch of them on iTunes and different sites. Thank you very much for the compliments. I hope that I'm helping everybody. Listeners who would like some written material to carry with you when you're out shopping, then get a copy of The Informed Buyer. You can buy it on Amazon, Amazon Kindle, or you can get it through Barnes & Noble Nook. It'll give you the basics for quick reference when you're in the buying process. And best of all, it's only $3. That's right, $3. Buy it. You'll be glad you did. No question about it. There are numerous insurance-type policies that you might have on your vehicle. I don't know if you ever sat down and thought about that, but there's a lot of insurance policies you could have. You might have gap insurance, in the event of a loss. That gap policy makes up for any difference between what you owe and what your loss is, versus the price of your vehicle in the marketplace. So if you owe $10,000 and the book says it's worth $8,000, the insurance company's only going to give you $8,000. They don't have to pay by what you owe. So that other $2,000 is paid by gap insurance. Fairly common problem for people who didn't have a large down payment. If you don't have a down payment on the vehicle, you should have gap insurance. If you have gap insurance, it's probably included in your monthly payment, right? If you bought it, you don't have to worry about paying it every month. And you pay one time, right? You pay it on at the beginning of your loan, and for the period of your loan, that's what it covers. You don't have to pay for it every year or anything. It's not renewable or any of that kind of stuff. Then you have extended service plans, aka extra warranty on your vehicle. That's kind of an insurance policy too, right? Much like insurance, it can be a good policy or a bad one. But that's food for another podcast. We can talk about that, but you can have a good one or a bad one. That too is probably included in your monthly payment if you have one, though. So if you got a vehicle, you financed it 5 years, and you got an extended warranty, that was spread out over the prices of the vehicle too. So you're paying it on a monthly basis. You don't see it coming out any more than the vehicle. Then there's your insurance policy for driving the vehicle. That covers any loss you might have from damage or flood or injury, minus a deductible. You'll have a deductible on a problem like collision. If you get in a wreck and it's your fault, a lot of people have, collision deductible of $500 or $1,000 or could have $2,000. As you already know, it's a yearly cost that's paid separately. And you pay your insurance on your vehicle every single year. And those numbers are all over the place, but around $1,000 to $1,500 annually might be a fair estimate of what the average is, somewhere in there. You can pay it by the month as a separate bill monthly, or you pay it all at once, but still you're going to pay it. Every year you're going to have it. It's going to be due. You're going to have to pay it one way or another. When you're getting your due diligence done and putting a deal together, like we do, hopefully, don't leave your motorist insurance out of the shopping process. Don't do that, I could tell you stories about different situations where people were shocked by what the insurance ended up costing them, but they already owned the vehicle. I have friends that say to me, I've been with this company for 20 years. I package the pricing with my homeowners. I get the best price, and nobody should save much, if anything at all, if they were in my shoes. Let me ask you, how do you know that? How much do you need to save to make shopping or changing companies worth your time? $200 a year? $400 a year? $800 a year? How much do you have to save? Well, guess what? $500 is well within the possibility in almost any case of what you might save if you shopped. Now, you might say, well, I have to go through that. I got to change my homeowner's policy. You can do it all together with any company. You can package your situation with anybody. And I don't package anything. I get the best price on the homeowners that I can handle with a decent company, with somebody that's got a good reputation. And I do the vehicle on a company. I don't try to package them because statistically, packages are worth zero. What's it have to do with a car deal? Your car insurance? What's that got to do with buying a car? Isn't it separate? Well, yes and no. It might be separate. Why not? We think of it as a separate item because the time to pay is seldom when you're buying the vehicle. The renewal date on your insurance would have nothing to do with whatever day you went out to buy a vehicle, right? But it really is part of the picture on a deal. And again, the savings or extra costs can be significant. Car, truck, motorcycle, motorhome, boat, any of these insurances could be checked and should be checked. And if you're like me, you check it every year. Now, I'm not saying you sell them down the river for $25. Heck no. Or $50 a year or something like that, or $5 a month, or, $10, even $10 a month, maybe you don't want to. But if I was saving $400 or $500, you can bet I would. What's wrong? I'd call an insurance company and say, hey, look, I can buy this insurance for $400 or $500 less. What the heck's going on? Some companies will go along with it. Some companies don't care because they're so big. We usually just call and transfer coverage or add coverage to a new vehicle. But quite often, when you buy a new vehicle, your rates can change. And when you renew, rates can change. We are all obliged to buy car insurance and continue insurance in order to drive. You have to have insurance. That's the law, right? What does that obligation mean? Advertising would make you believe that there's a highly competitive market for insurance, right? It's out there. It drives down the price. But that's not so. The heavy advertisers are not the least expensive or the best in terms of customer service, like you might think. You'd think because Geico's out there or Progressive's out there that they're the best ones, they're going to have the best rates, right? Because of their TV coverage. They give you that illusion that 15 minutes could save you 15% or $500. Progressive says you can save $500. Sure, it's possible if you have a high-priced company, but usually it's not the case. In fact, studies show that Progressive, who's the ones advertising all this, discounting a lot of it, right, averages the second highest rates in the country on average. In the entire, of all insurance companies. Allstate being the highest, by the way. In a recent study, they averaged $597 more than other companies. Average. That means that some people pay $1,000 more. Some people only pay $200 more. But the average was $600. It's difficult to tell a good deal from a bad in the insurance industry, though, right? It really is. Now, Dependable Consumer Report did a 2-year study a few years ago. I believe the study took place in 2016, I believe. From 2015 to 2017, according to my notes here. So it was 2015 and 16 for the study, and then 2017 is when the report came out. That's what it says here. And they did that study, and the study compared 700 companies. 700 insurance. I didn't even know there were that many. And 2 million price quotes. Yes, 2 million. And the things they found out are unbelievable. Some of them are against the law now. You can search on the net and find plenty of material and statistics about insurance, but I think some researchers have done the job and they aren't getting any kickbacks from anyone for what they've done. They just give you the facts. We all think that primarily driving record sets the rate, but not. It isn't primarily driver record that sets your rate. More often than not, credit score is what determines your rate on insurance. Insurance is regulated at the state level. Costs are all over the place, depending on the state, of course. Some states it costs more to insure in, like Florida's a little higher than some. I'll give you an example. That's why I talked about Michigan in other podcasts. That state has the highest insurance rates. It seems as though in the news lately, they got the highest everything. Man, I'm telling you, I'm not ever living in Michigan. An average credit score can cost you up to $500 a year compared to good credit, and a poor credit score could add $1,200 to $1,300 to your annual cost. I'm shocked. What's credit got to do with insurance? It does, though. Insurance companies are not obligated to tell you why they have looked up your credit score. Odd, but in Florida, a person with a DWI in the state of Florida could actually have a lower insurance cost than a person with bad credit. That's ludicrous, but it could happen. California, Hawaii, and now Mass do not allow insurance companies to use credit score as a source. In those states, it's more about your driving record and the fact that they can't use your credit score. And the fact that they can't use it is how they use it. I'll guarantee you they're looking at it. I don't care what the state says. Bad credit and a weak driving record can cause you to be uninsurable with many of the good companies. So if you got bad driving record and bad credit, you could end up not being able to buy insurance from the big companies. It also seems that many of the promised discounts don't really materialize according to the same report by Consumer Report. Student driving discounts or bundling homeowners policies often only affect it by $2 a month. Yes, $2 a month. It's hardly worth the work, right? A bundling often does nothing to the rate. They're all separate. It's like I had my car and my motorcycle through Geico, and then come to find out after a couple of years, that's because they were separate companies. They were under the Geico roof. You couldn't bundle those together because one company was doing the motorcycle insurance and another company, Geico, was doing the car insurance. So it didn't make any difference. If you let your insurance lapse and then you sign back up, it averages a $200 increase when you do. So if you didn't pay your insurance policy on time and you come back a month later and you say, oh, I'm sorry, and you're going to pay it, they can raise it up to an average of $200 just because of that. Another not so true is the loyalty discount most companies don't have that say they do. Many actually raise your rate because you're likely to accept the increase without objection. So if you're loyal, they kind of take advantage of that. Yeah, not every insurance company, but a lot of them do. In New Jersey, Geico has a loyalty penalty. Loyalty indicates that you won't shop, and this study showed that loyalty costs you more often than it saved you in the state of New Jersey, for instance, for whatever the reason. Government involvement or whatever. It's still the fact, right? Kind of like what I said about the biggest profit deals in the auto industry being friends and family, same idea. If the data says you're not a shopper, then your rate will go up more than someone that shops. So if you get a reputation as a shopper, it's a good thing. They're going to drop your rate a little bit. If you got a reputation of not shopping, you haven't checked your insurance in 5 or 6 years, well, they're going to bump it because you're not going to question it. Little bump, little bump, little bump. No. Who has the time, right? That's what they say. Well, I haven't got time. I got this. I'll get to that next week. I'll check it. You never do, though. Auto renewals set up for an unquestionable price hike if you automatically renew. People tend to renew their insurance without hesitation, and that allows for unquestioned increases. That's just how it is. They just take advantage of it because it's not something that you're going to become aware of. You're not going to question it. You're just going to accept that rate increase and move on. A little increase is sort of like, inflation and the cost of living. Those things go up. We accept, okay, that's easier than going and looking for insurance again and going through all the steps. There's not really any steps to it. You can take your declaration page. In your insurance, there's a thing called a declaration page. You take your declaration page, black out the prices so they don't know what your cost is, but put everything else in there that's covered, and fax that around to insurance companies. They can give you a quote. Yeah, that's all you need. It's that simple. And if you're going with a good company, I'm not saying to go with somebody you've never heard of, but there are a lot of good companies, not just one. There's more than Geico and Progressive. There's State Farm, and there's a whole bunch of them that are good companies. What's it cost to look, If it's not enough savings, then don't do it. Adding a teen can vary from company to company, too. That increase can be crazy. North Carolina averaged 159%. So you're paying $1,000 a year for your insurance. You add a teen to it, it's going to make it $590 more. People tend to accept the increase because it's a teen. They don't even shop it. On average, nationwide, adding a 16-year-old to your policy costs $500 to $600. But with some companies, the increase could be as much as $3,000. Do you know who those companies are? No, it could be yours. You don't know. You got to check. Doesn't cost anything to check. Free. Shopping is free. According to researchers, the national average lowest price companies are State Farm, Amica, and USAA. That was as of 2018. I don't know what it is now. It's probably the same. I don't have any reason to believe it wouldn't be. Don't take their word for it without checking. Check and compare it to your rate. Take the declaration page out of your policy. It's in there. It shows everything that you got on your insurance. Cross out the prices. Call an agent up for State Farm and one for Amica and USAA and say, look, I'd like to fax you this declaration page and get a quote on insurance. I'd like to get a new insurance policy. You don't have to tell them you're trying to beat yours. Just say, look, we're shopping for insurance. You don't have to explain why. And send it to them and see what happens. They'll ask you your driving record, and you can tell them that, right? Again, like everything having to do with big ticket purchases, shop. That's the big thing. Due diligence is no different on a car insurance, and it's part of the car deal. And with motorcycles, it could absolutely blow you right out of the box. It's unbelievable. I've had guys buy motorcycles, especially, metric, high-performance metrics, and had their insurance go up $3,000 a year, $4,000 a year. No baloney. I've had it happen. And if they bought the motorcycle and shopped and found out about the increase in insurance later, the dealer does not have to buy the motorcycle back. No. Once you take that motorcycle, they're not obligated for 5 seconds to take it back. And they won't. I'll tell you right now, they won't. If you don't know your insurance before you take delivery, that's your fault. That's your problem. All they have to do is call and transfer it. They don't have to make sure you're aware of the price. That should be the law, in my opinion. They should make it so that a dealer can't transfer your insurance unless they notify you of any price increase. All right? And that's not important to tell you if it goes down, but if it goes up, they should tell you. You should know about it in advance. But that's not the law. That should be. It's the perfect time to raise your rate, and in most cases, we don't question it when you purchase something. But when it's a motorcycle, it could just knock you right off your stool. Because a lot of companies have motorcycle insurance only so they can say that they insure everything. They don't really want to insure motorcycles. They don't really want to take that chance, so they make the price ridiculous. And then people end up getting them, and they're like, oh, God, I bought this vehicle. I didn't know it was going to cost me $4,000 a year for insurance. Sorry. That's your problem. You've got to sell it, and you've got to find someone to buy it then. Not the dealer's obligation at that point if you take delivery. Get out your policy and contact 3 companies for a quote based on the current coverage on your declaration page. Get it out and send it. See what happens. Doesn't cost anything to send it. Doesn't hurt you to send it. Your insurance company doesn't care that you sent it. And see what happens. See how, you got a copy of it. You make a copy of the declaration page, and then you mark off the prices so that you still have the price sheet, your original declaration page. And then when you get their quotes back, compare them. I'm telling you, there are times when you're going to be shocked at the difference in price. You're going to say, holy smokes, I'm paying $800 a year for insurance, and I can get it from these guys for $420. And you think, well, that's only $380. That's 50%. Holy moly, right? Extended service plans are pretty much fixed pricing. You don't do it with extended service plans. If you purchased a good factory plan, it's fixed pricing. We can cover that over a podcast, again, one of these days where we talk about what's involved in an extended service plan on your vehicle. It's important that you get the right one. That's the important part when it comes to those. They're all pretty much one price. There's no real shopping. It's not like Ford's going to quote you one price on a vehicle and they're going to quote someone else another price. No. The manufacturer has one price on their extended service plans, and it's just not discounted. It's not that, then they don't really do that much markup on it either. They're just trying to build customer loyalty and a happy customer with it. Gap's a little bit negotiable if you buy gap insurance, but it's a smaller number to begin with and only charged once. So let's say gap, the dealer's telling you is $750, and you can find somebody that'll sell it to you for $5. You're only going to pay it once. The total savings over the whole term of the vehicle is $250. And if you use that price from your insurance company with a dealer, you'll probably get them down to close to the price anyway. But the point is, it's not that a lot of money. But when it comes to your car insurance, we're talking about a lot of money, right? Automobile insurance is paid yearly and can vary by a huge amount from company to company during the average ownership. Let's say you own it 72 months. A person could end up saving $4,000 on the automobile insurance, all told, in that period that they own the vehicle. Sometimes, on some vehicles, it could be even a bigger deal than that. You could save $6,000 or $7,000 over the term of the ownership. Because again, like I said, you pay your automobile insurance yearly. It's not one time for the term of your loan. Although that's not a bad idea. Some insurance company could come out with that, where here's your insurance for the whole term of your loan and finance it right in. Sort of like your mortgage, right? It's in your mortgage payment. If they could do that, just think how appealing that would be. The vehicle's costing you $350 a month, including your insurance. Not a bad idea, is it? No. But and the point I'm trying to make is that if you shop the insurance, you could save a bundle. Now, maybe you won't. Okay, and you could call me up and say, you're wrong. I didn't save a nickel. My company's within $20 of everybody else. Okay, great. Wonderful. But you know what? That's not the case in many times. And who knows whether you're the one that's the case, right? Who knows if you're the one that's got a really good price on your insurance and it's not going to go up anymore? Who knows that? Nobody. That's my point. That's the whole point of this discussion, is that car insurance can change and differences can change, Like, for instance, once you shop your insurance, you'll find out that the difference between a collision deductible of $500 and a collision deductible of $1,000 is pretty significant. The savings could be a couple hundred just on that one thing. And you might find out that when you look at your declaration page, hey, I got $500 deductible on my vehicle, and my vehicle's 5 years old now. Why am I paying $500 deductible? It's not like, I might not even fix a dent if it got one. So that you should raise that. You might find that out when you look at the declaration page too. That's another good thing of not only shopping the prices from insurance company to insurance company, is you can take a look at what exactly are your coverages. Do you need them, and review them all by looking at that page and reading that page. Most of us don't. We just pay the bill and they get it in an envelope. And a lot of times it's a big envelope, right, with a bunch of pages in it, full-size letter type pages. And we just leave them right in the envelope and just shove the envelope in our drawer And we don't even open it a lot of times, right? Or we open it and tear off the insurance cards to carry with us, and we don't even read it. Read the declaration page. That's the page that's important. Read that one. Then make a copy of it. Cross off the prices. Call 3 insurance companies, ask them for a quote, and fax them that page. That whole process might take you 15 minutes. And that 15 minutes could save you $500 or 15%. There's no question about it. So try it. You got nothing to lose, right? Especially when you're buying a car. Make it part of the deal. Who knows, right? Well, that's Deal Talk for this week. If you have a question or request or even a comment, please call, text, or email me. Callers or text, dial 407-801-4071. That's 407-801-4071. Or email. It's dealtalk@mail.com or dealtalkpodcast@gmail.com. Please don't forget to do it review. Please don't. Do yourself a favor by getting a copy of Informed Buyer from Amazon or Nook. Yes, the Informed Buyer. Of all the things I ask you to do and tell you to do, that's the one you should do for yourself. That's really important. It's the best $3 you ever spent. What do you got to lose? $3. That's a candy bar. A good candy bar is more than $3. However I can help you, contact me and you'll hear from me. Every single person does. Just this week I had 2 people contact me this week, and I got right back to them, and they were pretty happy with the answers. And remember, every payment you get should be CPI, complete payment information, amount, months, rate, any required down payment to get to those terms, not on just the first payment quote, nope. But every single time they quote you a payment should be included with that information. Every single time. You think, well, it's kind of redundant. No, it isn't. Trust me, you want it every single time, so nothing can change. That's the whole point. And every price you get should be all in, everything in. None of this plus tag, plus fees. It's this price plus fees, plus dealer fees. No. Put every single cost required to buy the vehicle. The tax, the plates, the dealer fee, any aftermarket options, everything. Give me that price. They call that OTD, out the door.